Hey, Bernardo Wealth Extended Family, here to talk about inflation and the Fed. That's been the theme here for the last 2 years or so, Matt. Yeah. So I think it's important to really digest it. I think the market is really keeping that in focus in the forefront of kind of these ebbs and flows and a lot of positive performance here recently. So I want to break that down for you. It's interesting. We talked a lot about kind of this last 2 years, how our cycle is, 2 years ago, we're coming out of COVID, prices are going nuts, inflation starts to be looking like a problem. And the Fed, Janet Yellen recently said she wishes she didn't say inflation was transitory or temporary, right? And so remembering back then, it was hard to think and plan for investing because we didn't know, well, is the Fed like really serious and going to change rates, or are they changing the rhetoric kind of every day? And now we're on the other end of this, right, with a easing cycle looking like it's coming later this year. And the Fed in the fourth quarter of last year says, well, we think there's a case that inflation's under control and we should start lowering rates. We see markets rally. We see yields come lower. We kind of fast forward to the beginning part of this year. We hear the Fed kind of fumble around that a little bit now. Is inflation kind of, stubborn and not where we want? See some volatility. And fast forward to the meeting yesterday where Fed basically confirms their thesis that the market was expecting. We're going to keep rates where they are. We're going to look to 3 cuts later this year. Fed funds rates right now, 5.25 to 5.50 is their target. 2 or 3 drops, or 3 expected drops, 25 basis points each, puts us in the mid-4s. Well, the markets love that.
Yeah.
Right? So that's where we are. So that's kind of where we think things are. That'll be the genesis of our conversation today. And really, the first chart we wanted to pull up here was inflation, CPI versus core CPI. Kind of look back over time. This chart's pretty simple. On the left side, we're really just looking at the measure of inflation. On the right is time. Yep. And so you can see the purple and the blue just kind of charting those courses. Really want to pay attention to the far right here, Matt. Tell us what's going on in this chart.
Yeah, absolutely. So I know everyone's probably sick of hearing about COVID and the supply chain issues and the inflation that we experienced, but I think it is important to go back and kind of see the way the Fed reacted around that time frame, because I think it gives us a good indication about why they're being a little bit more patient this time. So if people kind of fast forward 2 years ago, that was when we got the first Fed hike, and Yellen and the whole Fed kind of said that things were being transitory and they were kind of late to really make an adjustment. My view is because they were late to make an adjustment then, they want to really make sure that they really see inflation coming down this time so they don't jump the gun and then potentially see inflation come back even stronger than it potentially would. So what you see on the left-hand side is obviously the inflation that we've all heard about over the last 2 years. But then I think what's most interesting, and it's very minuscule in the chart, but that throughout the summer, you can obviously see both the CPI headline and the core inflation coming down materially until we get to right around 3%. And kind of at the end of the summer and kind of at the end of the fall last year, people were anticipating there being 6 rate cuts because you were month over month, you're seeing inflation come down, come down, come down. And then we kind of hit that 3%, 3.1 or 3.2% floor. And we've really been sticking there. So people have talked about getting that last 1% to get down to the Fed's 2% target has been really sticky. And I think that that's why I've seen the Fed kind of pause and say, hey, like let's let this play out a little bit more, because I think people understand that like interest rate increases, they take time to really have an effect on the consumer and the underlying economy.
Right. And we talk about that a lot too, like the market moving before the Fed.
Yes,
right. So we saw that 2 years ago, right? The 10-year Treasury spiked well before the Fed ever raised interest rates. Yeah. And so now we're on the reverse side of that. We've seen the 10-year come down in anticipation of this, but we're still seeing volatility every time the Fed opens their mouth about anything with interest rates, even though they haven't touched interest rates.
Yeah.
Right. So that's a big piece of it.
And then so if we pull up the second slide, I think that it's really helpful to really view the Fed's 2 mandates that they have. It's to have stable prices of approximately 2% inflation, and they want to have a full and strong labor market. So what we can see here is that employment wages have been on average rising about 4%, which means that we just continue to have a strong U.S. consumer, which drives approximately 70% of the whole economy. So until we see really any sort of falter or any sort of cracks in the U.S. consumer and their spending capabilities, it's really difficult to see the Fed having to worry about the employment side of things.
Right.
Any thoughts on that?
Consumers are healthy. Consumers are still spending money, right? We're whether that's responsible or not too, because we've seen consumer debt like kind of falter a little bit, but that has kept the economy on track. And, kind of things keep rolling. I keep saying, like, it's very difficult in my mind to see a recession come without unemployment moving up, right? And so right now, I mean, even in our local community, we deal with a ton of business owners. It's still very hard to hire, right? This is still a very tight labor market. And so if you leave a job or you're through this rolling kind of layoffs, right? We saw technology have that happen when valuations came down big in 22, right? The technology market was kind of releasing jobs, but those workers could get right back into other areas, right? So this Fed mandate around employment doesn't have me too concerned, because I think that, they say, oh, we want to get to full employment. Well, I think we are at full employment. I think we're there already, right? So it kind of reverts right back to inflation.
Yeah. And perfect. So we'll go to the last slide here. So Nick, why don't you walk us through the Fed dot plot and what that really means for, obviously, what the Fed is signaling to markets, but also for client portfolios.
Yeah, absolutely. So the important chart, simple chart, it's really just showing and predicting what the Fed should do out into the future, where these target rates are going to be. So obviously the chart, you can see the general trend of these dots just can keep moving south, right, from a rate perspective. And what does that really mean for us as investors? I think it's positive for the equity markets, because a lower rate environment helps that market. I think the real key, though, too, is cash, right? We have, even as our business sits right here, we still have a lot of clients holding onto cash, right? We know this. It's a thing. It exists everywhere. Money markets are back, right? And have been back. 5.2%, right around there is where Schwab's paying for anybody to jump in and buy a money market. So to me, there's almost like this reprieve that investors have felt to jump in and say, oh man, I can earn risk-free 5.2% right now. Load me up on that, because I haven't had that for 15 years or however long it's been. And so now I think we're coming on the other side of that cycle. And so, Matt, give us comments around, kind of how we see, if this dot plot comes to fruition with the Fed lowering rates, what do we think cash versus maybe fixed income would look like? Where are we rewarded, and where do we have kind of risk in those types of scenarios?
Yeah, absolutely. And it is funny. If you look at the dot plots, it obviously shows for 2024, 2025, 2026, and then long term, where the Fed market participants see rates going. So right now, to your point, it's pretty easy to sit back, take no risk, and get a reasonable return. But the idea is that as every day, week, month, or year passes, the expectation is for rates to come down. And with that comes reinvestment risk. So right now, it's really nice that you're getting 5.25% on your money market yield paper. If we come in at the end of this year, right now what this chart shows is that the expectation is that rates should be on the front end kind of mid to high fours. So again, that's still okay, but it's going down. If you go out an even further year, you can see it continues to come down materially. So the idea that we're really expressing to clients is that it makes sense to take some of the money that you've kind of had on the sidelines within those money market accounts and start to extend out and buy some longer duration paper. So that's what we've started to do in client accounts.
Yeah, and that makes sense too, because there is an inverse relationship of bond values, right, to interest rates.
Yeah.
So as interest rates go higher, bond values come lower. Right, we've experienced that. Fortunately, last year we didn't. We made money in bonds last year, but 22, when rates were flying, bond prices took it on the chin. So we see the reverse of that right now. I think that's a good way to kind of conceptualize it in client portfolios. It's like, look, yields are going to be a little lower on the bond side than money market. But as that shift happens, we expect to see price appreciation on the bond side, which you never get price appreciation on a money market. It's just the yield, and your net asset value should stay, intact and the same.
Yeah, absolutely. And I would say by and large, when you think about fixed income or bonds, that really is the principal protection side of your portfolio. So like we primarily think about that as kind of clipping coupon and getting income. But I think we're in a unique position where typically the first movers who do go out and start to buy some more fixed income are the ones that are rewarded, so that as we can roll down the yield curve, as yields come down, you should see some potential appreciation within your bonds.
Perfect. Awesome. Thanks, Matt. Well, we hope this was helpful for you. Some complicated stuff, but hopefully baseline, pretty simple and straightforward what we expect, to see out of the Fed and markets, for this year. So as always, reach out with questions. We're here to help with that. And if not, we'll see you next time. Thanks.